Hey guys, welcome back to a brand new video. I'm RexFinance, and today, the day has come. We must call out some stupid stuff going on in the markets. And this is stuff happening on both sides of the aisle. And we're not talking about politics. No sirree. We're talking about bearishness and bullishness. There's stupid stuff going on the bear side of things, and there's also some stupid stuff going on the bull side of things. So this is going to be good for everybody, no matter what side of the aisle you're on. And honestly, this is going to be one of the most useful and informational videos I've ever done on my channel. So, if you're not subscribed, check below and make sure you're subscribed. It helps me out greatly. Also, leave a like and leave me a comment. I like to hear from everybody that watches my videos. It is super, super cool to put a face to a name. Even though you can't really do that very well on the internet, you get the point. I like engaging with you guys beyond just seeing my view count number, I guess. But before I dive into this video, I want to make this very, very clear, because this has cost investors so much money through the years, and it's going to cost investors so much money in the future. The markets can remain irrational longer than you can stay solvent, meaning even though there's stupid stuff going on both sides, the bulls and the bears, betting that all of this stupid stuff is going to fix itself and correct itself and normalize itself over the short term is not a good idea, because the markets can continue to be stupid and irrational longer than you can remain solvent. You could lose all of your money even though things are irrational, so do not go out there and place rash bets on the markets. But let's start with this. I saw a ridiculous video that was made today by Game of Trades. He's kind of a perma bear, but I can't make fun of him because I'm kind of a perma bull. I just think being a perma bull makes a lot more sense than being a perma bear, but to each his own, I guess. This video was titled, "This is Worse Than the 1929 and 2008 Yield Curve Inversions." Oh, handy. Two of the worst financial crises we've ever had in history. He just single-handedly picks these out of time and says that this yield curve inversion is worse than those ones. And he says really early on in the video that yield curve inversions predict recessions. This is not accurate at all, and this is something bears have been holding on to more than anything else when they say the stock market's going to crash and we're going to see this recession finally take place, even though they've been wrong about it for over a year now. Some bears are even convinced that yield curve inversions cause recessions. That is even less true. And if you go watch this video from Game of Trades, which I encourage you to watch it to see both sides of the aisle here, both pictures being painted to come up with your own conclusion. Don't just listen to me. Don't just listen to Game of Trades. Try and take in multiple perspectives to come up with your own conclusion. But he makes it very clear in this video that yield curve inversions are foolproof. Newsflash, they're not. It's not just Game of Trades saying this or implying this. It is every single bear in the stock market. Now, if that's due to lack of knowledge about yield curve inversions, lack of research, or just not knowing in general, I don't know what it is, but that is also very incorrect. The yield curve, which is the difference between the 10-year and the 2-year Treasury bill, simply predicts the Fed's policy cycle. It does not predict the business cycle. Now, yes, the Fed policy cycle can affect the business cycle, but the yield curve does not predict the business cycle. So the yield curve is not completely pointless. That's not what I'm saying here. It's actually a really, really good tool for investors to use. It provides very useful market signals. For example, right now, you can see that this yield curve inversion is a very, very deep one. Right now, the difference between the 10-year Treasury and the 2-year Treasury is about 1%. And what this yield curve inversion is signaling is that monetary policy is too tight right now. And because monetary policy is too tight, we risk seeing a financial crisis, which can cause a credit crunch, and credit crunches are what cause recessions. This yield curve inversion did actually accurately predict a financial crisis. Do you guys remember the collapse of Silicon Valley Bank, SVB? On March 10th, SVB failed after a bank run, marking the third largest bank failure in United States history. So the yield curve inversion did its job. It predicted this financial crisis. But you may have noticed we have not seen a recession. This yield curve inversion, at least so far, has not predicted a recession, though it has accurately predicted the financial crisis. So why could that be? Well, it's pretty simple. This time, The Fed acted immediately, quicker than they ever have before, and that's because they have learned from history. They have learned from 2007 and 2008, as well as 100 years ago in 1929. Every time a crisis pops up, we learn. Literally the morning of SVB's collapse, examiners from the Federal Reserve and FDIC arrived at the offices of SVB to assess the company's finances. At no point in history had we ever had a Fed even come close to acting that quickly. And you know why? Because they wanted to prevent that credit crunch that can turn into a recession. And they provided an emergency liquidity facility for SVB and other struggling banks, which prevented that credit crunch. And I'll discuss the different false positives we've seen with the yield curve inversion through history in just a little bit, but I think it's more important right now to actually explain why this yield curve inversion has been so accurate at predicting recessions. A lot of it has to do with what I already mentioned. We didn't have the data, we didn't have the history, we didn't have the experience to know as a Federal Reserve, as a central bank, how to act and react to different financial crises in the economy. So specifically in the 1900s, when we lacked all of this experience, this yield curve inversion was really pretty dang accurate. In the past, the Federal Reserve would raise interest rates during an economic boom cycle to basically prevent an acceleration of inflation. And they did this by acting very aggressively, probably to establish that credibility as inflation fighters, because runaway inflation is no good for the long-standing economy. But what this aggressive action caused was not the recession. It caused the credit crunches that caused the recession. So it still holds true. Back in the 1900s, the yield curve inversion was very accurate at predicting credit crunches, and whenever you have a credit crunch, you more than likely have a recession. Unless you're an absolute nerd, you probably haven't heard of Regulation Q, and I hadn't either until I looked into the yield curve. But especially in the 1960s and 70s, tightening monetary conditions often triggered this credit crunch, as I've already mentioned, and that's because Regulation Q, or Reg Q, put a ceiling on interest rates that could be paid out on depositors' money at banks. It gets somewhat into the weeds here, but basically what this all led to was even the most credit-worthy borrowers being unable to take out a loan, and that's because bankers were both less willing and able to provide loans to these borrowers, all as a result of Regulation Q. So especially in the second half of the 1900s, when the Fed was well known to raise rates during economic boom cycles to limit the upside and acceleration of inflation, investors would front run that, and they'd sense this credit tightness, this instability, this stress in the credit markets, and they would pile into treasury bonds because they expected a credit crunch as a result of the Fed's actions. And we've already established credit crunches lead to recessions. Yield curve inversions do not. So let's suffice this all by saying if we can prevent credit crunches, we probably won't see a recession. And so far, the Fed has been very good at preventing a credit crunch this time as we're sitting here in 2023. And that again is a direct result of how fast they acted when SVB basically collapsed. If you really diagnose the yield curve, you'll find many false positives, but today I'm going to be focusing on two of those. Most bears out there don't even know that false positives exist. They believe that this is 100% foolproof. Whenever the yield curve inverts, we're seeing a recession. And the first yield curve inversion that I want to look at happened in June of 1998. The reason that the yield curve inverted in 1998 was because people were fearful that the Asian financial crisis would basically spread into the United States of America and cause the USA to have a recession. In 1997 to 1998, Asian financial crisis began in Thailand and then quickly spread to neighboring economies. There was massive fear that this was going to be a widespread global recession, but the recession never came to the USA, rendering this yield curve inversion in 1998 incorrect. And most recently, we had a yield curve inversion come towards the end of 2019. This also was associated with market perceptions of significant risk to the global economy, the global economic outlook, including the threat of escalating trade tensions between China and the USA. The threat of escalating trade disputes, as well as the president at the time wanting relatively low interest rates, caused the yield curve to invert. And lo and behold, between July 2018 and August 2019, the United States announced plans to impose tariffs on more than $550 billion of Chinese products, and China retaliated with tariffs on more than $185 billion of U.S. goods. That matches right up with this August of 2019 yield curve inversion. And if it weren't for the pandemic, we would not have seen a recession. Now, if you're really studious, you might be looking at this and saying, well, that inversion in 2019 was barely an inversion, and that inversion in 1998 was barely an inversion, and that is very correct. Absolutely correct. Compared to how inverted we are today, 2019 and 1998 were basically nothing. And my explanation for this is I actually believe that this yield curve inversion is being manufactured by the Federal Reserve. We have a very aggressive Fed that continues to be hawkish despite inflation falling very, very quickly. We're already almost to the Fed's target rate of 2% on inflation, yet we still think that at the end of July, they're going to raise rates another 25 basis points. And whenever you have a hyper-aggressive Fed, they raise short-term rates. Short-term rates are affected much more than long-term rates when the Federal Reserve raises the federal funds rate. And this makes sense. Let's go back to the fact that the yield curve is a great predictor of monetary policy, not the business cycle. This essentially means that investors over the long term expect interest rates to be lower than they are today, which ask yourself, I think everybody would agree with this. Do you think interest rates will be higher today than next year? Over the next 2 years? Over the next 5 years? Over the next 10 years? Perhaps your answer is yes for all of them, and that would make sense because we are in an ongoing battle against inflation right now. But once the Federal Reserve declares victory over inflation, they can start cutting rates or moderating rates. And what does that do? It brings short-term rates back down, and if long-term rates even stay the same, this yield curve inversion starts to inflect back upwards. And I forgot to mention, but it's actually a really important point. In 2019 and in 1998, both of those were examples of international risks that investors thought would affect the United States in the end. They weren't the United States' problems. And this is another reason I think the yield curve is going to be less reliable when we try and decide when we're going to see another recession. It's because the bond market through the years, especially in the 21st century, has become much more globalized, impacted by other major central banks around the world. So this yield curve is going to be less and less indicative of the United States economy as time goes on and time unfolds, and other major central banks play a factor into the United States bond market. I think we can draw 3 different conclusions from the yield curve. When the yield curve is widening, it means that the Fed can tighten policy without risking a recession. If the yield curve is flattening, it means the Fed should either slow their interest rate hikes or pause them altogether. And when the yield curve is inverted, it signals that monetary policy is too tight and easing should be in order. Now, there's nobody out there that disagrees. Monetary policy right now is way too tight. Bulls and bears alike can agree on that. And then lastly, on the bull side of things, it's getting stupid as well, with AI in particular. Like today, Apple reported that, what was the headline? Apple races to develop own generative AI to catch OpenAI, and their stock is skyrocketed 2% over the course of 10 minutes. This added $60 billion of market value to Apple. In 10 minutes, the value of Apple went up by $60 billion, all based on a headline that they were going to develop their own generative AI. The reason I think this is stupid is because this should not be happening. This is a sign of greed. This is a sign of froth in the markets. This is a sign of a potential bubble forming. Any company that mentions AI, their stock price just rockets. And over the short term, as a result of this, over the short term, and I've said this for a while, I believe we are going to dramatically overhype AI, but over the long term, we're going to vastly underhype the powers of AI and what it can do for our businesses. AI is going to make our businesses more profitable. AI is going to make workers more productive. AI is going to be the trend that leads to continued economic growth in the United States and abroad. But right now, when Apple mentions a headline, they're going to develop their own generative AI, and that adds $60 billion of market cap in the snap of a finger. That's just stupid. But again, I want to remind everybody, The markets can remain irrational much longer than you can remain solvent. Don't make a stupid decision betting against AI stocks over the short term because you think it's stupid right now, because you will lose your money. And on the same token, don't go out there and buy a bunch of short-term call options because you think the yield curve inversion thesis that bears are sharing right now is stupid. Don't do it. You will lose your money. But all of this being said, I'm not a financial advisor. Please don't take anything I said today as financial advice. But if you're new here or returning and not yet subscribed and you enjoyed this video, please hit the like button down below as well as hit the subscribe button for me. If you want to join my membership where we go in depth like this, like we did in this video, almost every week with members exclusive videos, you get weekly previews, economic outlooks, everything you would ever want in a membership, and it's for the cheapest price on YouTube. Hit the join button right next to the subscribe button or hit my Patreon link that's in my pinned comment. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.